Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show in just a bit, we will have our special guest here. Our guest host, Rob Wessel, Executive Chair and Co-Founder at Hamilton ETFs. He will help set the stage for all the major banks and everything that is unfolding with them. Of course, we're getting our first earnings report right now as well. So we'll talk about that in just a second. And then, of course, we're unpacking the expert's playbook on how to make a sound art investment. There's money to be made in it with the Fine Art Group's president of the Americas, Anita Harriet. And, of course, we want to hear from you on this morning on First Call. Call us with your questions on Canadian banks, and we'll have Rob answer as many of them as he can. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Bank of Nova Scotia topped profit estimates in its latest quarter on better than expected results at its capital markets and wealth management divisions, the financial services company. Also booked a restructuring charge primarily related to workforce reductions. Scotiabank is 2 years into a strategic overhaul with its international division tracking ahead of plans, while earnings growth at home have been slower. Laurentian Bank is selling itself to Fairstone for $1.9 billion. Fairstone is a privately held Canadian lender that also offers a variety of other financial products. Before the transaction closes, National Bank will acquire all of Laurentian's retail and small business assets and liabilities. Laurentian put itself up for sale in 2023, but couldn't find a buyer back then. LA Base Metals has signed an agreement with Glencore to jointly evaluate a potential copper development project at their adjacent properties near Sudbury, Ontario. If it all works out, Vale and Glencore intend to transition to a joint venture as equal partners in the project. The agreement involves working out of existing infrastructure at Glencore's mine in that area. And now, our top-line story. Bank of Nova Scotia topped estimates on better than expected results at its capital markets and wealth management divisions, even as it booked a restructuring charge to cut expenses. Let's bring in our guest co-host, Rob Wessel, Executive Chair and Co-Founder at Hamilton ETFs. Rob, thanks very much for joining us.
Thank you for having me, Roger.
Let's talk. This is the first bank we're seeing the earnings for. Initial reaction. Rob, can you hear us?
I did not. No, I'm sorry. The audio cut out.
Just your initial reaction, the first of the banks reporting, initial reation to the numbers you're seeing.
Yeah, so I mean, Scotia reported a pretty good quarter. It was a solid beat. They came in at $1.93, I think, and consensus was $1.85. As you pointed out in your opening remarks, there was a bit of noise, restructuring charge, and legal provision. The restructuring charge, should put some at the margins downward pressure on forward expenses. But more importantly, credit was stable. Very, very importantly, performing provisions, which the market spends a lot of time on because it's very discretionary, or would appear very discretionary, were up modestly, but still much lower than where they've been in previous quarters. I think that's a pretty key takeaway because the market is very much focused on them staying low as a supporter of forward estimates. Canadian banking, which is always a focus for Scotia, was flat. I think it's probably fine. And, they had some margin expansion. They had some good capital markets. And regulatory capital remains strong, and they continue to buy back shares. So I think all in all, the market will be pretty happy with this quarter. And then in terms of guidance, that'll also be important. The analysts will flush that out on the call, but they're looking for quote unquote strong earnings growth. So we'll see how that all plays out and how the analysts and how it impacts consensus.
Now, with Canada, the Canadian sector, do you see more layoffs there possibly to try and help boost it?
That's hard to say. I mean, it would seem to suggest the restructuring charge in and of itself would seem to suggest that there's layoffs coming, as well as, for compensation. Canada is by definition the biggest part of the bank. So I haven't looked at the details. So I don't know if they broke it out by business line. But, I think, listen, right now, that's a key focus of the market, Canadian banking. And one of the things that the banks can control is expenses. So by definition, I think at minimum, the market will be very focused on, can they keep those expenses, flat to down?
And right now, I'm just looking pre-market right now. That's down about 1%. How do you think the market's going to react when the bell goes?
Well, we'll see. I mean, the call is pretty determinative, particularly as it relates to guidance. I'm a bit surprised. I mean, I guess the question is, will it underperform the group? I think it'll probably have on a relative basis, a good day. As we know, the banks are trading, and I know we're going to talk about this in the next segment, but the banks are trading at healthy multiples. So there's a lot of good news priced in. So even if this is good news, the question will be, is it good enough news?
And will it be good? Do you feel it's good enough news?
On a relative basis, I think that they'll make up some ground. It's very hard to do day-to-day trading. I think, the bigger question for Bank of Nova Scotia on a prospective basis is they trade at a large discount. One of the reasons they do is because their ROE is quite low, and the market obviously is concerned about Canadian banking, which is fine. So, how it does in the next 6 to 9 months, this is a grind, right? These are super tankers. These stocks do not move quickly, the operating profitability does not move quickly. And so, Bank of Nova Scotia is going to this is a long journey. They're going to have to every quarter get some incremental improvements and try to get their ROE up so that they can, get some relative multiple expansion. Because right now this bank trades at a very big discount.
And is this kind of an indicator for the other banks, or do we have to take them individually, do you think?
No. Well, so that's a good question. I think, generally speaking, the beat was for reasons and drivers that affect everybody. There was nothing really terribly idiosyncratic about Scotia's results. For example, it wasn't like international banking was on fire and therefore there's no real read-through to everybody else. But no, I mean, credit was stable to, performing allowances or performing provisions were low. Capital markets were strong. Margins were expansion. These are expanded. So these are all things that affect the banks together, maybe not to the same degree. It depends on the bank. But yeah, I think this is a positive read-through. But again, expectations were high coming into the quarter, so it's going to be hard to sort all this stuff out.
And CEO Scott Thompson said this quarter was all of our business lines reported year-over-year earnings growth. They're 2 years into that strategic overhaul. Does it look like they're on track? We talked about, of course, the numbers being off in Canada, but does the bigger picture, does it look like he's on track?
Yeah, I think so. It's a big journey, though. They have a lot of room to make up. I mean, their ROE is quite a bit lower than everybody else's, or not everybody else's. Their ROE is quite a bit lower than the average. And as I said, these are big companies. It's very hard to move them quickly. So this is like the ground game in football. You're just trying to move 2 yards at a time, 3 yards at a time, in order to try to make progress. Nothing happens fast.
And I imagine people don't want to see things happen fast to a degree with banks, do they?
I think that's true.
All right. Well, we'll leave it there. We're going to talk about a couple of other banks. Well, 3 banks, actually, that are involved in this little trade that's coming up and little sale that's coming up. But we'll take a look at the markets before the bell first. And that was Rob Wessel, Executive Chair and Co-founder of Hamilton ETFs. He's our guest host this morning with us. See how things are shaping up on the markets for this morning. We begin with the U.S. futures, and yesterday's losses snapped a nice multi-day winning streak, but the futures are pointing back to a positive day today. Everyone is awaiting key economic data and any signals from the Fed, of course. And right now, you can see they're all in the green. Heading over to Asia now, and it's good day there. Most of them are up except for the CSI 300. Again, it's the hopes of a Fed rate cut being offset, though, by worries about Japanese yields and softer Chinese data. But the Nikkei, well, that's a wash for the Nikkei. Things hang up by a quarter, and the CSI 300 up by about a half. In Europe, all in the green there. The banks are benefiting from a likely rate cut in the U.S. Defensives such as utilities also attracting investors, and that is helping fuel things. You can see the FTSE up by more than 0.2%. CAC 40 up by 0.3%, and the German DAX up by a half a point. And taking a look at the TSX, it finished the day yesterday off from that record high. It was led by a decline in banks ahead of earnings and parts of the tech sector as investors snagged some profits. It was down by 0.9%. But some of the movers, let's take a look here. Bausch Health having a good day, 11.26%. It was up. Curaleaf rebounding a little bit, up by 4.63%. Shopify down 6.3%, and Celestica down by 7.2%. Okay, silver and gold, some profit taking, slightly firmer bond yields, putting downward pressure on them. You can see both are off. Gold down by nearly 1%, and silver off by nearly 2% from its still sitting around its record highs, but it's had quite the surge in the last little while. And copper in the red as well, off by 0.73%. Taking a look at oil, Western Canadian Select finished the day up by 0.94%. Now, an OPEC Plus promise to pause production increases is being offset by oversupply fears and softer global demand. So let's see what WTI is doing right now. It's down by nearly a quarter point, but still above that $59 mark. Well, Laurentian Bank reached a deal to sell itself to Fairstone Bank for $1.9 billion, all part of a strategy to refocus the bank on its commercial lending operations. Just prior to the transaction closing, National Bank of Canada agreed to acquire all of Laurentian's retail and small business assets and liabilities. Fairstone has agreed to pay $40.50 per share in cash for Laurentian, which had been up for sale in 2023 but failed to find a buyer and has been undergoing a strategic overhaul since then. Let's bring our guest co-host, Rob Wessel, back in. He's the executive chair and co-founder of Hamilton ETFs. Rob, what do you think of this deal, this kind of three-way deal that's going on right now?
Yeah, I mean, it's small, but I mean, I'm actually not familiar with Fairstone, and I'm guessing that 99% of your audience is not either. So I don't know that people need to worry about that one so much. On Laurentian, this is kind of, I don't want to see the end of an era, but we now have the two small banks are gone, Canadian Western Bank and Laurentian. And Laurentian has been struggling for a very long period of time. Almost my entire career, 30-plus year career, Laurentian has struggled. They managed to sell off of a reasonable multiple. So I think Laurentian is not that big a deal. I think the market will probably focus much more on National Bank, which is obviously a very, very successful company. And I think at the margins, this is not a marginal transaction. For National Bank, this is actually a pretty good one. They acquire retail loans and deposits. They get some SME loans. They get some small, medium enterprises, what SME stands for, and some deposits. It looks like it's going to be accretive to about 2%. It's going to be accretive to ROE. So, this is essentially a book value transaction. And so, it just incrementally strengthens National Bank in Quebec, which is obviously their ballast or their moat, if you will. Mm-hmm. And I think actually quite notably, National Bank does not have to close any branches. They don't have to fire anybody or anything like that. That is strictly with Laurentian. So I think on the whole, the market is going to like this for National Bank.
Yeah, just talking a little bit about Fairstone. It's a lot of personal loans, it looks like. Quick personal loans, anywhere from $500 to $60,000 is what they do. And some home equity loans and retail financing. So it'll be interesting to see how they see this fitting in with them.
Yeah, I mean, they don't, to the best of my knowledge, they're not public, so I'm not sure it's going to be the focus of the market today. But at least as a vehicle to taking out Laurentian, that's, we'll see how it goes. But Laurentian, I mean, this is as good as it gets for them. So it's hard to believe this transaction won't close, especially when it's a 20% premium, give or take, to yesterday's close.
20% is what they're saying.
Yeah. I think the market will accept. I think it's hard to imagine that transaction would be voted down by shareholders.
So you see it moving ahead, but still not clear where everybody's where the Fairstone is going to go with this, though.
Yeah, I mean, Laurentian is small. It's not really owned, in a significant way by the market. I think the market today will focus on the implications to National Bank, which is, obviously much larger, much more successful, and much more owned.
And how do you think it's going to react to National?
I think this is a positive. Listen, this is a very well-run company. They have a very high ROE relative to the group, for example, in contrast to Scotia, which reported today as a much, much lower ROE. And, they've had very strong earnings growth. It's a very, very well-managed company. And so this is yet another example of strong management taking opportunities. Even if it's not a huge transaction, they still managed to, it looks like, they'll get some ROE accretions out of it, which is very good for a bank that already has a much higher ROE than the average, them and Royal. And the fact it picks up 2% of EPS is also worth noting. So I think this is a positive data point for National amongst lots of positive data points for them.
Is there room for any other acquisitions like this in Canadian banking, or is it
No,
pretty tight? It's a pretty tight field, isn't it?
It's gone. Yeah, I mean, Canadian Western Bank gone, Laurentian gone. I mean, there's nothing. Let me put it this way: given how big these companies are now, there's absolutely nothing that would move the needle in banking and within Canada. And now, and HSBC obviously was the big one.
And where does this leave National then, relative to everybody else?
You mean in terms of
size-wise, and footprint?
I mean, this bank has outperformed by a significant margin for a very long period of time. They just had, they have a new CEO, relatively newish CEO, putting his mark on the bank and putting a positive mark on the bank. Since Laurent Ferreira took over, they've bought Canadian Western Bank. They'll pick up this. I mean, there's just a lot of motion at National Bank, and they're not standing pat. And given the bank has had higher than average EPS growth and a much higher ROE, I think they're in good shape.
Oh. All right, we'll leave it on that note there. Rob, thanks as always for sticking around, and we're going to talk some more coming up after the break about some choices you like. Rob Wessel is the executive chair and co-founder at Hamilton ETFs. And coming up next, we'll be back with him to take a look at the rest of the Canadian banking sector, see what's on his radar. It has been a busy morning for the Canadian banks, and that momentum will continue through the week with Royal Bank and National reporting on Wednesday, CIBC, Bank of Montreal, and TD on Thursday. For a full sector outlook, we're back with Rob Wessel, executive chair and co-founder at Hamilton ETFs. And Rob, let's talk, first up, I guess, the first two that are coming in tomorrow, talk about RBC. What are we going to be looking for from them?
Oh, I think it's going to be, it probably makes more sense to think about the entire group. It's going to be very hard to do bank by bank. But I think at the end of the day, as we talked about in the first segment, most of the takeaways and the positive drivers for Bank of Nova Scotia were all drivers that affect all of the banks. And so, I think this is a pretty good backdrop. So getting some margin expansion, having strong capital markets, having stable credit, in particular, the performing allowances, those are all positive data points. Capital is very, very high. Some of the banks are buying back shares. And, obviously there's obviously differences. So for Royal Bank, which you asked about, they have very, very strong capital markets, as does National Bank. So I think you would expect them to disproportionately benefit if the trends from Scotia, hold for the entire group. Margins, also positive for pretty much everybody. And capital, as I said, continues to be strong. So the banks are going to continue to look for either capital deployment opportunities or they're going to continue to buy back shares. Buy back shares for TD and Scotia, for example, deployment opportunities for most of the other banks. Not a lot of buybacks are going to be taking place at these valuations, or probably not. So I think it's maybe a bit more for those two. But I really think the biggest issue for Canadian bank investors, the really big issue, and I don't think we know the answer to this, is, right now, the market or consensus is for basically double-digit earnings per share growth for 26 and 27. Mm-hmm. And so because there's some pretty high EPS growth expectations built in, on top of that, the banks are actually trading at multiples that are quite a bit higher than what they historically trade at. So if I'm looking at my screen here using Bloomberg, they trade at 13.5 times, the next for fiscal 26, and 12.1 times fiscal 27. So right now, I think, we can talk about, what are the details here and there and some of the drivers. But the real question is going to be, when they report, is this consistent with the expectations of the market? And that's going to maybe vary by bank. But at the end of the day, the banks are trading at very robust multiples. So they're going to need to have strong earnings to continue to hold these prices.
And can you see investors staying away till maybe the multiples drop, or do you want to, or will the strong earnings
I think
keep them there?
Yeah, so usually in this situation, I mean, if in absence of a broader market correction, it's possible that, one way to get the multiples down is the stocks languish until earnings per share growth, builds the multiples down. But it's probably more, the market is hoping, I think, that earnings estimates are continually revised higher, and that brings the multiples down to a more reasonable level. And, and obviously people are embedded in these valuations is, some optimism about the economy. It's hard to believe that they're trading at 13 times, over 13 times next year's earnings and over 12 times the following year's earnings if people are not constructive on the economy at minimum.
Now, with the economy, what are some stressors that could have an impact?
Well, I mean, fiscal policy is obviously going to be a key driver. We'll see if you can get some pro-growth fiscal policy. I mean, all of these issues around, nation-building projects and things like that, those are years and years and years away. What happens in the here and now in terms of capital investment, in terms of unemployment, GDP growth, any sort of fiscal consolidation to get the deficit under control doesn't seem at hand. And obviously, our neighbor to the south and the issues around trade is a pretty big unknown variable. And it seems like the market is sanguine about all of these things, and therefore, they're optimistic that the Canadian banks will see credit improvements, and that will support valuations. If they don't get that kind of credit improvement, then the banks could have a tough year.
But right now, it's sounding like people are going to be okay with what we're.
Yeah, I think so. I mean,
this is going to see.
Yeah, I mean, listen, if Scotia is indicative of the other four banks, this is a positive. I don't think you'll see a significant move in the markets. Having said that, not to sound like on one hand, on the other hand, but we don't know. I mean, it's going to be hard to say. These are strong valuations, and they're building in some optimism. And probably the biggest source of that is capital markets, the biggest source of that would be credit. And possibly the idea that performing provisions not only stay low, but maybe go negative and become recoveries, or just impaired provisions fall as well, and that you have a constructive capital markets backdrop. Those things are necessary preconditions to supporting these estimates, if not seeing them revised higher.
Okay, we're going to leave it there for now, but Rob, stick around. We've got a different kind of investment coming up. We're unpacking the expert's playbook on how to make a sound art investment. And our phone lines will be open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email as well, first call at bellmedia.ca. Bank of Nova Scotia topped estimates on better-than-expected results at its capital markets and wealth management divisions. The financial service company also booked a restructuring charge primarily related to workforce reductions. Scotiabank is 2 years into a strategic overhaul, with its international division tracking ahead of plans, while earnings growth at home has been slower. Vale Base Metals has signed an agreement with Glencore Canada to jointly evaluate potential brownfield copper development project at their adjacent properties in the Sudbury Basin. Upon completion of the early work, Vale Base Metals and its Glencore intend to transition to a joint venture as equal partners in the project. Go Easy CEO Dan Rees will step down from the consumer lender effective December 31st due to a blood disorder that requires him to resign. Patrick Enns, who is president of Easy Financial, will become CEO on January 1st. Rees will serve as special advisor to the CEO through June 30th. And taking a look at the markets, the streak ended yesterday, but it looks like it's about to resume, or at least for today right now. Everything's in the green. You can see the Dow up by about 0.1516, NASDAQ up by almost 0.4, and the S&P 500 up by a quarter in the futures. Well, the last little while, we've seen a couple of record sales. Sotheby's saw a Gustav Klimt portrait of Elizabeth Lederer go for 330 million Canadian. A gold toilet considered art went for 12 million. So is art an investment? Our next guest has encountered many savvy business professionals who fumbled when trying to make that perfect art deal. With decades of experience, she knows all the pitfalls of art investing and how to make an informed decision. Here to share her wealth of knowledge is the Fine Art Group's president of the Americas, Anita Harriet. Anita, thank you very much for joining us.
Well, thank you so much. Glad to be here.
I have to ask, who or what buys something like that Klimt painting for 330 million Canadian?
Someone very, very wealthy. Well, what's really interesting is when we're asked all the time by ultra wealthy clients, I'm interested in diversifying my portfolio. Art is an interesting investment. It's semi-liquid. You can park, if you're buying the right thing, you can park your money there. It can sit there. It doesn't fluctuate the way we see, stocks fluctuate. So they'll say, like, what percentage of my portfolio should be in these assets? And this brings me to the Klimt, as I'll get there, I promise. And, typically, we don't like to see clients exceed more than 4% of their, overall wealth portfolio in art investment. Now that can fluctuate up or down depending on a client's real passion for that asset. But so to give you a sense, if someone's spending over $200 million in an artwork, note that means, their true wealth is, tremendously higher if, it's somewhere below 10% of their, portfolio. So, we did see what is pretty interesting is that kind of post 2009, when we saw the market just crash and we thought, oh, who's going to buy a piece of art? Nobody. What we actually saw was an incredible increase in the acquisition of these art as assets, and primarily coming from countries that hadn't traditionally kind of gotten involved in these kinds of acquisitions. China, Taiwan, Russia at the time, not now, Brazil, India, Middle East. So what we've seen over the last 20 years is a real entrance in the marketplace of ultra high net worth clients that are really interested in acquiring these works for a variety of different reasons. Everything from showing kind of nonverbal ways of communicating power, right? You walk into a house and you see a Klimt.
You're going to go,
there's something important going on.
It's not that print I have from MoMA. What kind of a return does art offer? And I mean, for the people who aren't the ultra wealthy, can you invest in it? Are there ways to look at art as an investment?
Of course. But like any investment, whether you're buying a stock or buying a piece of real estate or doing forensics on a business, it's all about the due diligence. So of course you can acquire artwork as an asset, but when you look at an asset, you're thinking ROI, right? Mm-hmm. And I have a lot of clients, we have a huge advisory business, meaning we help clients buy, and clients will say, hey, I'd like to buy art. Great. And then I say, all right, are you okay with taking $100,000 in one bucket and putting it in another and having it worth zero? And they're always like, no, I don't want that. And I'm like, well, that's called a decorative acquisition, right? It has nothing to do with ROI. It has nothing to do with investment. But if you don't do your due diligence, that can happen. And they're like, well, no, I don't want that. And I say, well, if you have $100,000 in one bucket and you put in another, do you want it still to be worth $100,000? I'm like, yeah, I want that. And that's financial preservation. So you can buy art to hold its value, but there are kind of 9 categories of analysis we use to determine value. And if any of those is a D or an F rated, you could have something that is not a good acquisition. The third kind of client says, I have money in one bucket, I want to put it in another. Is it, are you looking for ROI? And that is a completely different methodology you utilize when you're looking for ROI than you would for financial preservation.
Okay, I want to bring Rob in for a second, who's our guest co-host this morning. Rob, you have a question for Anita.
Yeah, I was just curious is if you think of art and you use the analogy of the stock market, are there parts of art that are kind of have higher growth potential and maybe higher risk? And are there parts of art that have maybe more stable returns and have a more predictable outcome for those more conservative art investors?
Terrific question. I love the way you asked it. Yeah, so we have what's called kind of blue chip art, and blue chip art's like a blue chip stock, right? It's steady Eddie. And these are typically artists that kind of change the way we look at art history, right? They're like catalysts of change, watershed moments in art history. So think Monet, think Picasso, right? Think Basquiat. And again, you could buy terrible Monets and terrible Basquiat. So again, that due diligence is still really, really important. But if you acquire them, it's like you can park your money there and to buy a good one at a good price, and it's a solid investment. Will it grow exponentially? No, but it will hold its value. But then there's a whole group of artists, and we saw this specifically when the market was out of control, especially around from 2015 to 2022, with a little COVID in between. We saw people investing in living artists that those categories of analysis we use don't apply necessarily. And these are artists that are acquired by significant galleries, but they didn't change the way we look at art history, right? They're risky acquisitions, but what we see is a lot of flipping of these artworks. They spike high, they go low, and a few of them hold their value over time. And when clients say like, hey, I want to buy new artists, I'm really interested in, buying and selling. And I'm like, well, great. Do you like penny stocks? I'm like, what? So it's the same. There's no difference. But there are additional levels of due diligence we do when clients do want to buy living artists who don't have strong, long careers.
Can you have any emotion in this, or if you're looking to buy stuff, do you have to actually just remove all emotion from it? I mean, because in the end, some of the stuff you'll actually have hanging on your wall, and it's still an investment. Can you have any emotion when you're investing in art?
Well, my job is to take the emotion out, right? I'm like a robot, and that's what I need to do for my clients, because I don't want them in an auction house bidding, right? The thing about auction is it works when you have two bidders who are psychologically connected to the experience, right? That's all you need are two bidders. So our job is to kind of get in front of that, determine value, and basically set a baseline for what's appropriate in the market. However, a lot of people who collect art and wine and other assets and jewelry, it's experiential, right? You can still live with your art, which is one of the great things about the investment, right? Mm-hmm. I have an artwork right behind me. So it is experiential. You can have passion, but you really do need to have an unemotional side to that process. And that's why, it's important to work with someone who knows what they're doing.
Okay. On that note, Anita, thanks very much for joining us and educating us. We appreciate it.
Of course. All right. Well, thanks so much. Have a great day.
You too. Anita Harriet is president of the Americas for the Fine Art Group. And coming up, we will have more. We've been watching shares of Air Transat after activist investor Pierre-Carl Pelado demanded a board shakeup and strategic overhaul of the travel company. We'll bring you our conversation with Pelado after this. And of course, our phone lines are open. Rob Wessel is taking your questions on Canadian banks. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. Watching shares of Air Transat after activist investor Pierre-Carl Pelado demanded a board shakeup and strategic overhaul of the travel company. We sat down earlier with Pelado, owner of Financière Outremont, to discuss the latest update on if the current board has responded to a request for a meeting.
A company that have a market cap of $80 million. And I think that at this stage, regarding the balance sheet and the situation of the company, it will worth much more, to invest in the business, and instead of, investing at the board of directors and everything that goes with it. So then therefore, given, and I've been there for many months, even many years now, reviewing what was the strategy of the company, and we're forced, to conclude that right now, everything that had been taken by the board had been mostly a failure. So the balance sheet is broken. We need to fix the balance sheet, because they will not going to take any other investment will take place without making sure that, we're going to arrive at the first base. It's like a baseball game, If you want to go at the second or the third base, you need to go to the first. And the first base for this company is to fix the balance sheet.
Okay.
It's completely the opposite of the industry. It is the worst balance sheet that you've seen. And then therefore, if you don't fix it, you run the risk, to get this business out of business one day or another.
Okay, so let's talk a little bit about support. There are 11 board members, I understand. You want to take it down to 6. You want to be on the board. Have you been talking to other shareholders or board members about this? What kind of support have you had?
Yeah, we've been talking with other shareholders. I think that, we're completely aligned. Every shareholders would like to see, this business moving forward successfully. There's 2 large shareholders. One is la Caisse de dépôt and the other one is the Fonds de solidarité de la FTQ. We've been in discussion because, again, everyone believes this company have a very strong brand. They've been at the heart of Quebecers for so many years. This business is in the right position or in the right industry because it's a growing industry. We all know that life expectation brings people spending more, traveling more. But you need to have, the proper strategy and, again, the proper balance sheet to be able to succeed.
That being said, they have made some progress on paying down their debt. It was $800 million a year ago. Now it's under $400 million, or at least it was by end of summer. I believe that was the beginning or end of July, beginning of August. So they are making progress there. You think you can make that situation come about more quickly, cutting the debt more quickly?
The debt reduction comes from a write-off of the largest creditor, which is, the government of Canada, that had been helping, the company during the pandemic. Today, you're in front of quite of a situation of a kind, I would say. Here's a company that is major creditor is the government of Canada. Here's a company that the largest shareholder is the government of Canada. And here's, a company where the regulator is the government of Canada. So how can you really, believe in the future of the company if you sit on different seats like this? And one day, you'll be for the red and the other day you'll be for the blue. That doesn't make sense.
Okay. So you want to cut, sorry to interrupt you. I'm running on limited time. You want to cut the board, which will cut costs, but how else would you reduce debt for this company?
Yeah, again, we need to restructure the balance sheet and then therefore, sit with the major creditors and making sure that, we'll be able to find the proper balance of debt and also in terms of cash injections. Because today, any dollar that will be invested in the company will go directly, reducing the government of Canada debt. So you cannot ensure the viability of the company with that kind of conditions that you have right now. If you want to succeed, then you need to make sure that you will invest in the company, invest in the product, invest in the customer service. I use the example of Videotron that had been very, very successful since we took over in 2000. It is the company that had been able to invest in wireless. We grew significantly there. Customer service, we have the proper balance sheet. We've been investing in the proper places. And this is what we would like to do with Transat. So, again, illustrated, with what we've been able to do. Okay. We're in front of the company where the board was incapable of moving the needle. It's been there. We're facing a failure. And then, therefore, we need some significant changes. And this is what we're proposing down the road.
And Marilla was speaking with Pierre-Carl Pelledeau, owner of Financière Outremont. And coming up, we will have a look at some of the notable analyst calls and recommendations. Let's take a look at some of the notable analyst calls and recommendations. First up, Darling Ingredients. The shares there are up 2.6% in pre-market trading after TD Cowen upgraded the agricultural producer to buy from hold. Analyst Jason Gabelman said, "We base our outlook on an expectation that Diamond Green diesel margins will improve structurally from more favorable industry regulations, including the 26-27 renewable volume obligation to be finalized in the coming months. The price target, set at 45, up from 34. Cloudflare Inc. Those shares are up 2.8% in pre-market trading after Barclays launched coverage on the infrastructure software company with an overweight rating and a $235 price target. Analyst Saket Kalia says Cloudflare's homogeneous network supports 20% of the internet, and the company is levered to cloud adoption, cybersecurity, AI inference, and no-click search. Six Flags Entertainment, the shares for it are up 4.3% in pre-market trading after Truist Securities upgraded the theme park operator stock to buy from hold. Analyst Charles Scholl sees a number of potential positives for the company, though he stresses that there is no denying fund has issues. He also said the new CEO, with a significant experience in theme park operations, sounds promising, and clear acknowledgement on the most recent earnings call that action needs to be taken to shed underperforming parks, and seemingly a greater sense of urgency to do so is encouraging. And when we come back, Rob Wessel will take your questions on First Call. Time for First Call. First email for this one, and Rob, here's the email. It's from Rob. What's Rob's take on TD Bank? Should I take a position? Would it be for income?
So TD Bank has been the story of the year, I guess. It's actually been the story probably of the last 2 years with the massive and unbelievably terrible regulatory challenges that they faced in the United States, and the massive fines, to selling Schwab, turning the story on a dime, selling Schwab, and basically turning the story from we have all this regulatory risk to what do we do with $20 billion or $15 billion net of taxes, and how much does it fund buyback? So I think TD has had, like, it's obviously been a massive performer coming off of a low base. But yeah, I mean, listen, we're going to see what happens in this quarter, but they do have some regulatory challenges. They have not gone away. They're probably not going to be able to deploy capital very much in the short term, and their multiple has largely recovered from its regulatory lows, we'll call it. And they do trade at the average 13 times this year and call it 12 times next year. So I think what you should expect from TD over the next 12 months is just more normal, more in line with the group, more stability, more predictability, as all of the other banks, and they are going to be buying back shares probably in a meaningful way, and that should give some support to earnings per share estimates, which should also support the stock.
And is it a bad thing that they can't do much with that money short term, or that they can kind of sit for a second and figure out a game plan, or are they ready to go, do you think?
Yeah, so this is probably a much larger conversation, but I'll try to get to the Coles notes of it. So they do have an awful lot of, they've got just a gigantic capital amount to deploy. The most obvious area where there's the most opportunity is the United States. But given the regulatory challenges they've had, I think it's unlikely they're going to go to the U.S. regulator and say, we would like to buy something. Obviously, they can't buy a U.S. bank because they're precluded from doing that for probably the rest of my career. But over on the other side, could they buy a full service broker, an asset manager, or a capital markets platform? Yes, eventually, but probably not in the short term. So I think you've seen them emphasize, particularly their investor day, capital return. So I think for now, huge capital, short term, or we'll call it the next 2 years or so, going to be focused on capital return and buybacks. And then after that, after some of these regulatory issues have settled down, then they might be looking more in deployment. Obviously, they could buy something in Canada today or in Europe, for example. But I think right now, you should look at TD as all of the crazy stuff that's happened and all the significant movements. That stuff is largely behind them. Now it's steady state, lots of capital, regulatory risk still lurking in the background.
All right, let's get email from Bruce now. CIBC or BMO, which do you prefer and why?
Well, I mean, I normally don't give individual stock picks, but here I'll weigh in. Right now, and I'm gonna avoid the question, by the way, if that's okay.
Yeah.
But what I'm gonna say is Bank of Montreal is not a singular bet, but right now, Bank of Montreal, has had significant credit problems from the acquisition of Bank of the West, which was the biggest acquisition in Canadian bank history. And right now the market believes that they're going to experience significant and meaningful credit improvements, and therefore earnings per share growth for them is 13% a year forecast for the next 2 years. Those are big numbers, and they traded a high PE multiple. So I think if you're maybe a bit more risk averse or you want a bit more predictability, you're probably a bit better off in CIBC, which trades at yes, it doesn't have the same earnings per share growth profile, but it also doesn't have the same credit problems. And it trades at a much, much lower multiple. So I think in the here and now over the next 12 months, right now with Bank of Montreal, you are hoping and betting on, quite frankly, very significant credit improvements. You don't need to make that bet with CIBC.
Okay, we're going to have to wrap it up there, Rob, but thanks as always for joining us. We appreciate it.
No, thank you. Thank you for having me.
That's Rob Wessel, Executive Chair and co-founder of Hamilton ETFs, joining us today. Andy Bell is coming up with the Open next, and the markets will open about 30 minutes from now. Have a great day.